M&A in Focus, 2024 Review and 2025 Predictions. Hello and welcome to a review of M&A for 2024 and where the market may head in 2025. I am Christopher Kummer, the founder and CEO of the Institute for Mergers, Acquisitions and Alliances, and it's a pleasure to dive into this topic with you today. In this video, we'll take a journey to cover the key highlights of the M&A market in 2024 and explore what's driving optimism for 2025. So let's move to the first section and look at M&A in 2024. While large deal activity, deals valued at over $500 million saw a modest increase, it remained at the lower end of the historical average range. This was partly attributed to reduced business confidence due to the challenging deal landscape. Mega deals, those being transactions valued at over $10 billion, declined compared to 2022 and 2023, with only 17 reported in the first 9 months of 2024. Private equity deal-making experienced a resurgence driven by record levels of dry powder, almost $2.6 trillion at the beginning of 2024, and a need to deploy capital. This led to an increase in private equity-backed deals, particularly in technology and finance. Venture capital funding saw an uptick in the second quarter, especially in North America and Europe. However, overall activity remained below 2021 levels, with a significant funding gap notable for many early-stage companies. Artificial intelligence companies continued to attract significant investment despite concerns about market saturation, inflated valuations, and an AI bubble. Collaborative ventures, including joint ventures and partnerships, continued to gain popularity as companies sought to access new markets, technologies, and capabilities. Regulatory pressures continued to weigh on deal pipelines. The pre-close timelines for contested transactions grew longer, increasing both costs and risks for dealmakers. Additionally, many companies opted to pause their M&A plans, awaiting the results of elections and hoping for clearer signals on the future regulatory landscape. Here's what we saw influencing M&A in 2024. Geopolitical tensions, including the Ukraine-Russia war and tension in the Middle East, potential economic slowdowns and evolving regulations, made dealmakers hesitant to commit to transactions. In July, the UK election outcome was decided, and by November 6th, attention had shifted to the US as companies awaited potential changes under a new administration. Will regulators adopt a more lenient stance, encouraging companies to revive deals previously put on hold and paving the way for a robust M&A market in 2025? Or would anticipated increases in deficit spending and tariffs reignite inflation, ultimately dampening deal activity? Increased oversight, particularly in technology, extended deal closing timelines, adding complexity and discouraging some M&A activity. Companies prioritized transformative acquisitions aligned with long-term goals over high volumes of smaller deals. Modestly declining interest rates improved investor confidence, providing a more favorable financing environment. Companies leveraged ample cash reserves to pursue acquisitions, supporting deal activity. Better alignment between buyer and seller expectations facilitated smoother negotiations and deal closures than in 2023, when valuations were in disequilibrium. The 2025 M&A market outlook appears more optimistic compared to 2024. Most experts predict a significant increase in M&A activity in 2025, building on the modest gains seen in 2024. The EY Parthenon Deal Barometer forecasts a 10% rise in total deal volume in 2025. Willis Towers Watson also expects deal flow to increase in 2025, particularly in the mid-market segment. This is corroborated by a KPMG study, which found that 57% of dealmakers predict higher deal volume in 2025 compared to 2024. We can look at several macro factors that are set to drive M&A in 2025. With uncertainty from the 2024 US and UK elections having subsided, M&A leaders are expected to pursue acquisitions with greater confidence. A more positive economic outlook for 2025, supported by steady US GDP growth of 2%, cooling inflation, stable corporate profits, and improving equity valuations, will create a favorable environment for deal-making. The Federal Reserve's rate-cutting cycle, which began in 2024, is expected to continue into 2025. Lower interest rates will reduce acquisition financing costs, driving private equity deal-making and bridging valuation gaps. A KPMG study indicates 90% of deal-makers believe lower interest rates will significantly boost deal volume. Lower financing costs and rising stock valuations are expected to align buyer and seller expectations, facilitating smoother and more successful transactions. Corporations and private equity firms are eager to deploy record amounts of capital. Private equity dry powder reached a record $2.1 trillion by September 2024, further supporting a resurgence in deal-making activity. Corporations are also holding substantial cash reserves, creating pent-up demand for acquisitions. The mid-market segment is predicted to be a driving force in the anticipated M&A recovery of 2025. Several factors point to this trend. Mid-market companies are increasingly looking to M&A for consolidation and inorganic growth opportunities. They are driven by the need to expand their market share and achieve scale, margin pressure, the pursuit of scale, a drive to enhance their competitive edge, the necessity to accelerate digital transformation. Private equity firms with record sums of dry powder are actively seeking investment opportunities in the mid-market. This is partly due to a shortage of high-quality targets in the larger cap market, the perception of greater value and growth potential in the mid-market. As large corporations restructure and focus on core businesses, they are expected to divest non-core assets, creating opportunities for mid-market buyers. Declining interest rates and a positive economic outlook are expected to make financing acquisitions more accessible for mid-market companies. Dealmakers are increasingly focused on strategic and transformational M&A to reshape their businesses and adapt to evolving market dynamics. This includes acquiring new capabilities, expanding into new markets, and divesting non-core assets. KPMG notes that 52% of corporate and 58% of PE respondents plan to pursue at least one strategic transformational deal in 2025. Willis Towers Watson predicts that mid-market M&A activity will surge in 2025, driven by these factors and increasing margin pressure on mid-sized businesses. Certain industries are expected to experience strong M&A activity in 2025. It's no surprise that the technology sector is expected to continue to be a hotbed for M&A in 2025. This will be driven by a renewed focus on growth-oriented assets, long-term trends such as cloud computing, AI adoption, and the need to acquire digital competencies. Specifically, generative AI is attracting significant attention. Many companies are pursuing acquisitions of Gen AI technology, products, and talent to enhance their competitive edge. AI deals are likely to attract premium valuations for all of 2025. However, acquirers must remain pragmatic, ensuring any premiums paid are balanced with realistic synergy realization plans. The oil and gas sector is predicted to continue its consolidation trend in 2025. M&A activity is likely to be driven by the ongoing energy transition, the need to secure critical resources for sustainable technologies, and the industry's ongoing fragmentation. Private equity firms are expected to play a key role in driving M&A growth in 2025. The EY Parthenon Deal Barometer predicts a 16% rise in PE deals in 2025. PE firms are sitting on record levels of dry powder, eager to deploy capital into new investments. Lower interest rates are expected to further encourage PE deal-making, particularly leveraged buyouts. KPMG reports that 70% of PE firms expect higher deal volume in 2024 compared to 2023, and 84% anticipate even greater activity in 2025. Despite green shoots of recovery, dealmakers will need to navigate potential headwinds in 2025, such as geopolitical tensions, regulatory scrutiny, and economic volatility. Heightened geopolitical tensions could make companies more cautious about pursuing cross-border transactions. For example, ongoing conflicts in the Middle East and Ukraine-Russia, trade tensions between the US and China, And the potential for the Trump administration to implement a wave of tariffs could create uncertainties that deter deal-making. Regulatory scrutiny and protectionist measures driven by nationalistic policies are expected to continue to pose challenges for cross-border deals, particularly in sectors like technology and steel. Looking ahead to 2025, dealmakers are set to adapt their strategies to navigate regulatory challenges. They are likely to dedicate more time upfront to rigorous deal screening, proactively assessing antitrust risks and identifying potential asset divestitures early to improve the chances of approval. These efforts will aim to minimize wasted time and resources on deals unlikely to succeed. Some players are likely to steer clear of high-risk transactions altogether, while others will remain cautious. Overall, dealmakers will need to carefully assess the geopolitical landscape and develop strategies that mitigate risks while capitalizing on emerging opportunities. This will involve monitoring political developments, conducting thorough due diligence to assess potential risks, developing contingency plans to address unforeseen events, building strong relationships with government and regulatory bodies, and seeking expert advice on navigating complex geopolitical and regulatory environments. In 2025, navigating the M&A landscape will require a sharp focus on geopolitical dynamics, proactive risk management, and strategic adaptability. By staying informed, prepared, and connected, dealmakers can turn challenges into opportunities and position themselves for success in a complex global market. Visit the IMAA website for the latest trends and expert updates to help you stay ahead. See you next time.